Most investors say they want to buy the dip. But when markets fall sharply, fear often dominates behavior. Instead of reacting emotionally, I rely on a structured framework. That helps me observe the market's emotional state through data. Today, I'll walk through how I translate fear and sentiment into measurable signals. Many people reference the idea of being cautious when others are greedy, and constructive when others are fearful. But the real challenge is this. How do we measure fear objectively? One useful tool is the VIX, the market's volatility index. Historically, when the VIX rises above 30, it reflects elevated uncertainty and stress. These periods often coincide with market declines. However, they can also represent environments where emotional selling dominates rational positioning. To implement volatility data, I also monitor the Fear and Greed Index. This tracks investors' sentiment on a scale from 0 to 100. During periods of stress, volatility tends to rise, while sentiment tends to fall. When both occur at the same time, the market may be entering an emotionally extreme phase. When VIX rises above 30 and fear and greed falls below 25, I treat this as a preparation signal. It tells me to observe more closely, not to act immediately. Once this condition appears, I look for technical confirmation. Signal 1 is sentiment. Signal 2 is oversold condition. This occurs when SI drops below 30. Signal 3 is momentum stabilization. This includes price reclaiming short-term averages and MACD beginning to turn. Instead of attempting to identify a precise bottom, I wait for stabilization. Because timing exact bottoms is unreliable, I use a staged allocation approach. Stage 1 establishes initial exposure. Stage 2 increases allocation. Stage 3 completes positioning. This process focuses on structure, not prediction. Subsequent market stabilization often follows such conditions. The key takeaway is not the event, but that structural signals often appear before sentiment shifts. This framework does not predict bottoms. It helps reduce emotional decision-making. Markets remain uncertain. Luck will always play a role. But disciplined processes can improve consistency. Successful investing is not about reacting faster. It is about maintaining a repeatable system. By quantifying fear, opportunities may emerge. During periods of perceived risk, would you be prepared to act systematically? During periods of extreme fear? By quantifying fear, you can find opportunities where others only see risk. Now I want to hear from you. How do you view the current market? Do you think we will see extreme fear again soon? And are you disciplined enough to follow your system when it happens? Leave a comment below, and if you found